client is king. So the absolute decision-making power is on the side of the client. So everybody else has to adapt depending on the part of the cycle we're in.
Hello and welcome to another edition of our weekly Tea Break series. This week we're delighted to be joined by Miguel Burguet, Portfolio Manager at Marlowe Capital. Miguel, how are you?
Very well, thank you.
And what tea are you going for?
Oh, it's a chai tea because it looks to me like the sovereign bonds market. It's hot, loud, and increasingly spicy.
Fascinating. Yuri?
The tea, it always has that human touch for me because it has to be brewed, individually made. The coffee, it feels algorithmic, computerized. They put it in a machine now. And I know that you've been skeptical, Miguel, about these algorithmic approach to business and to asset management because the systems don't always work with the increased uncertainty coming from the White House. Do you feel that those portfolios have to have the human touch?
I mean, there are some very, very successful algorithm-based funds like the Shore, Renaissance Technologies and others. But on the AI, I think that it's very difficult for a model like that to understand exactly what's the trade policy that is coming now from the White House. It is obviously a very complex negotiation style. And for example, analyzing something deeply conceptually, like the next crisis. We think at Marlowe that the next crisis is going to be very different to 2008, not based on banking leverage or financial innovation, but on sovereign indebtedness and the interlinks between Forex, repo markets, and global portfolios of hedge funds. So very different set of indicators, which I'm not sure AI, which may work very well for some things on the short term, is able to pick.
Ali, you've been talking also to the SS&C founder, Bill Stone, and this was quite a visionary man. 40 years ago, it was a startup in his bedroom in Connecticut, and now this is one of the largest technology companies for asset management.
We can learn a lot from him, about opportunities he sees in changing demographics and new markets, with expansion in the high growth hubs like the Middle East. It's a really critical lesson from Bill, that leaders must listen to people, to show kindness, recognition of abilities in their workforce and patience.
So listen to people, not just the machines.
Not just the machines, yeah, exactly. Miguel, you secured your first job in the city just before the credit crunch in 2007. Have the leaders of the banks you've worked with and those which you select for your portfolios always showed the long-term vision, kindness and moral leadership which our writers, including Malik Sarwar, have been advocating in some of our opinion pieces?
2007, that's a long time ago. That's when I was young. So basically, we invest in banks, and just to give a bit of context, at Marlowe, we are the first ever spin-off from the finance department of LSE. We follow a macro-based approach, but of course, the quality, the moral quality of the CEO is absolutely key. We look at the management team, long track records, and that they are people you can trust your money to.
Last week I was chairing a FT webinar about managing assets in the Trump 2.0 era, and I was asking some of these leaders, what have they learned from previous crises? And sometimes you think they haven't actually learned very much, because if we look at the 2008, they were managing the hedge funds and they were trying to convince everybody to go into hedge funds. Now they're trying to convince everybody to go into private equity and the private markets. And we see the patterns repeating themselves. And we look at the GFC, Russia's invasion of Ukraine, Trump's accession to the White House and his destruction of global order. And we think, have they had any impact on the way these people work? So it's interesting to read our colleague Elisa's analysis of net wealth, which is the brainchild of a former Goldman Sachs and JP Morgan banker, Charlotte Ransom. And we've got a brilliant question on this very topic from a reader, Manuel Perez at Deloitte in Switzerland, who asks you, Miguel, what would you say are the major challenges of that traditional wealth management model which they're facing right now, and these new tech-driven disruptors? Are they really a threat to the traditional model?
traditional, investment managers focused on value, like the Warren Buffett, the Grahams, the Fishers. That is a strategy that has been always there, always worked well, and probably it will work well in the future. But algorithmic trading is having a big impact in certain segments, and some of these funds are doing obviously extremely well. I think AI on certain short-term strategies, like for example volatility analysis, credit sentiment analysis of the market, they can be good. So they could affect part of the strategies, but the, let's say, hardcore traditional ones, they have always worked. I would say that in terms of asset management companies, the situation right now is hyper competition. So there are so many strategies, so many people on this, so many big companies doing everything, that is difficult to justify I have an edge, and hence my existence is justified. The answer to hyper competition, hyper specialization, and as well focus on returns. Not so much in big AUMs, huge asset managers, but on making money for the clients.
And as well as making money for the clients, Miguel, we have to engage with the clients. And that topic of engagement is something you've been looking at, Ali, in your piece on Asian family offices. What did you find?
William Chow, who runs the Raffles family office in Hong Kong, I found his take quite interesting. He talked about the vital role of the family office in managing generational divergence, between different cohorts, that each generation's investment appetite can vary, from traditional real estate to innovative cryptocurrencies, and that we need to offer them a bridge connecting these diverse perspectives. And Miguel, are investment firms and private banks recognizing these different appetites, needs of generations and investing cohorts, or are they just, force-feeding them all the same flavor of the month products, which happen to be private markets, as you just mentioned?
Client is king. So the absolute decision-making power is on the side of the client. So everybody else has to adapt depending on the part of the cycle we're in. Right now, we think we are entering or we are already in the upper part of the cycle. So some products are going to be pushed, are going to be offered, because maybe companies, they think that they fit better with the client. They'll be easier to sell. I would talk, for example, about private credit or startups, technology investments, which they work very well at the upper part of the cycle. But, when the cycle turns, maybe that could be out of fashion very quick.
Well, we're certainly not force-feeding anybody any tea or coffee. They get a freedom of choice in our canteen.
And the choice is growing every day, so...
I give my testimony on that.
Miguel, thank you so much for joining us.
Thanks a lot.
Don't forget to catch our weekly episodes on the PWM website or our YouTube channel. And if you've got any questions for our guests, you'll find everything you need online. See you next week.